to market strategy.
Hello, welcome everyone to Market Strategies. Today we will be introduced to how to hedge using weekly Sensex options. Two excellent strategies for the weekly expiry, Iron Butterfly and Iron Condor. We will analyze them with calculations. Entry for this can be taken half an hour before the market close on the day before expiry. Today is January 7th. The time is 3 hours 5 minutes in the afternoon. The Sensex spot is trading at the level of 84,900. Its expiry is tomorrow. If carried out consistently every week, out of 10 trades, 5 to 7 can be booked in profit. Even if only 3 or 4 out of 10 trades are successful, you will still be in profit. If in the 1 or 2 days prior to taking entry, the Sensex has made a movement of more than 500 points, avoid the risk. However, looking at the probability, there is a higher chance of profit here. Now, let's see how to select the strikes. Pay attention to where the spot is trading. The call option and put option, which are at-the-money strikes, can be chosen for selling. It is because the expiry has only 24 hours that we are selling strikes this close. Combo 1, Iron Butterfly. Here, we are selling the 84,900 call option and put option. Observe the premium received. For the 84,900 put option, 146 rupees 25 paise is received, and for the call option, 155 rupees 90 paise is received. The total credit received is 302 rupees 15 paise. Now, let's understand its hedging logic. Whatever the total premium received while selling is, the strikes we need to pay attention to are the ones obtained when that amount is added to or subtracted from the sold strike. Here, although a 300-point difference can be taken, we are taking the buy entries at a 200-point difference. To buy the 84,700 put option, 70 rupees 15 paise must be paid, and to buy the 85,100 call option, 77 rupees 20 paise must be paid. The total amount paid is 147 rupees 35 paise. Let's see how to find the maximum profit. From the total 302 rupees 15 paise we received, subtract the 147 rupees 35 paise we paid for hedging. Then, the 154 rupees 80 paise we get is our per point profit. Multiplying this by Sensex's lot size of 20, 3,096 rupees is obtained as the maximum profit. Let's see what the maximum loss is. The distance between the strike we sold and the strike we bought is 200 points. From these 200 points, subtract our net premium of 154 rupees 80 paise. Then, the 45.20 paise we get is our per point loss. Multiplying this by Sensex's lot size of 20, the mere 904 rupees we get is our maximum loss. The safe zone, or break-even point, adding the net premium of 154 rupees 80 paise to the sold strike of 84,900 gives the upper break-even point of 85,054 rupees 80 paise. And subtracting the net premium of 154 rupees 80 paise from the sold strike of 84,900 gives the lower break-even point of 84,745.20 rupees. The meaning of this: at the time of expiry, if the Sensex is between these 2 points, that is, no matter where it closes between 84,745.20 and 85,054.80, we will be in profit. Combo 2, Iron Condor. Here, we are selling strikes that are 100 points away from the spot, slightly distant out of the money strikes. Observe the premium received. For the 84,800 put option, 98 rupees is received, and for the 85,000 call option, 118 rupees 60 paise is received. The total credit received is 216 rupees 60 paise. Let's see what we are buying for safety. To buy the 84,600 put option, 45 rupees 55 paise is paid, and to buy the 85,200 call option, 56 rupees 5 paise is paid. The total amount paid is 101 rupees 60 paise. Let's see what we are buying for safety. To buy the 84,600 put option, 45 rupees 55 paise is paid, and to buy the 85,200 call option, 56 rupees 5 paise is paid. The total amount paid is 101 rupees 60 paise. Let's see how to find the maximum profit. From the total 216 rupees 60 paise we received, subtract the 101 rupees 60 paise we paid for hedging. Then, the 115 rupees we get is our per point profit. Multiplying this by Sensex's lot size of 20, 2,300 rupees is obtained as the maximum profit. Let's see what the maximum loss is. Here too, the distance between the strike we sold and the strike we bought is 200 points. From these 200 points, subtract our net premium of 115 rupees. Then, the 85 points we get is our per point loss. Multiplying this by Sensex's lot size of 20, the 1,700 rupees we get is our maximum loss. To see the safe zone or break-even point of this, adding the net premium of 115 rupees to the sold call strike of 85,000 gives the upper break-even point of 85,115. And subtracting the net premium of 115 rupees from the sold put strike of 84,800 gives the lower break-even point of 84,685. At the time of expiry, if the Sensex is between these 2 points, that is, no matter where it closes between 84,685 and 85,115, we will be in profit. Now, let's see how much money is needed on hand to do such trades. Although regular option selling requires a large amount, because we are hedging, for each combo entry, approximately 70,000 rupees final margin will be required. The main difference between these two combos is this. Even though the profit is less, the Iron Condor, which has a larger break-even range, has a higher probability of getting profit. That is, even if the market moves a bit, we will remain safe. However, if the Sensex stays within a particular range without much volatility, getting more profit will be in the Iron Butterfly. Based on your risk capacity and market condition, you can decide which one you need. How to select the sell strikes? That is, look at where the spot is trading. One call option and one put option, which are at-the-money strikes, or only two at-the-money call options, or only two at-the-money put options can be chosen for selling. The premium we receive when selling is the most important. If there is more premium in the at-the-money strikes being sold, it is more preferable to instead sell out-of-the-money call options and put options that are 100 or 200 points away. If this video was useful to you, do not forget to like and share. Record your valuable opinions in the comment box below. For such knowledge in the stock market, subscribe to Market Strategies. Thank you. Goodbye.